Physical silver, which I'd bought on an average of $20 an ounce, had exceeded handily my target. I bought the stuff at 20 because it was hated. And you and I talked about this in an interview 4 or 5 years ago, the fact that silver was absolutely hated and a coiled spring. And I said to you that I thought that silver could handily take out its old nominal high at $50. Well, I was wrong. It took out 75 instead. The fact is that I bought the silver because I thought it was oversold and hated, and I thought it would recover. With regards to silver, as I said, I bought it because at $20, I believed it could go to 50. I believe it would do so in 2 years, which meant that I would enjoy a 2-year double. I was wrong. I enjoyed a 2-year triple or better. I would tell people that although I sold my physical silver last week, I haven't sold my physical gold. Most people don't own physical gold. It's not like most people have trading positions to trim because they don't have any positions whatsoever.
Legendary resource investor Rick Rule explains that his physical silver purchase at $20 an ounce far exceeded expectations. Bought when silver was deeply hated and undervalued, the metal was expected to reach $50, but instead surged past 75. Delivering a 2-year triple rather than a double. Having achieved his investment objective, Rule sold most of his physical silver while continuing to hold physical gold. He emphasizes that gold remains underowned and essential as a long-term store of value. Unlike silver, gold is rarely held by the public, leaving significant upside as monetary conditions continue to pressure the U.S. dollar. Now, we present the clips from Rick Rule's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
I would tell people that although I sold my physical silver last week, I haven't sold my physical gold. Most people don't own physical gold. It's not like most people have trading positions to trim because they don't have any positions whatsoever. How do you trim nothing, you know? And I would urge people who are interested in this to play back some of the earlier interviews that you and I did about the arithmetic of America, about why I believe that the purchasing power of the U.S. dollar declines by 75% over 10 years. This isn't a number that I drew out of air. It's a number that, while not certain, is, I think, arithmetically sound. I think, too, that it's likely, but not certain, likely based on history, that the gold price mirrors, in nominal terms at least, the deterioration in the purchasing power of the U.S. dollar, suggesting roughly that gold will maintain its purchasing power across a broad basket of goods and services, while the dollar will lose 75% of its purchasing power over 10 years. Does that mean that 2026 is going to be as kind to gold holders as 2025? Unlikely, because you only make up for lost time once. Remember that gold was substantially underowned, substantially underpriced 2 years ago. It was that coiled spring that began to come unsprung. Future moves in the gold price are going to have to be earned by the deterioration of the purchasing power of the U.S. dollar. I would suggest that most of the tension in the spring has been released in this dramatic move that we've seen. What happened in 2025 is that the smallest and gamiest of the mining stocks moved too, in very dramatic fashion. The consequence of that is that we have an odd market. The metals moved, the best of the best moved, but not as far as we would have expected, and the rest moved much further than we would have expected. What that's meant for me, personally, was that in October, I sold 25% of my junior stock portfolio, my junior mining portfolio, because I felt that the sector was ahead of itself. I felt, too, that by selling off 25% of my upside, I could eliminate my downside, which seemed like a very good trade. It is a truism that you haven't made the money until you've taken the money. What's probably instructive is what I did with the proceeds. I took half the proceeds and I bought physical gold, and a package of 3 senior gold stocks, Franco-Nevada, Wheaton, and Agnico Eagle, which is to say I didn't exit the sector. I just de-risked. I went to beta. Normally in a bull market, you would go from beta to alpha. But as I say, this market short-circuited beta and went straight to alpha. And so I de-risked. Much more recently, last week, I noticed that in my own portfolio, physical silver, which I'd bought on an average of $20 an ounce, had exceeded handily my target. I bought the stuff at 20 because it was hated. And you and I talked about this in an interview 4 or 5 years ago, the fact that silver was absolutely hated and a coiled spring. And I said to you that I thought that silver could handily take out its old nominal high at $50. Well, I was wrong. It took out 75 instead. The fact is that I bought the silver because I thought it was oversold and hated, and I thought it would recover. When my investment objectives were reached, I sold my silver, my physical silver, at least 80% of it. Now, there's a lot of people who are in place in silver, and for them, well, they have nothing to sell.
Rick Rule shares his strategy of holding physical gold while selling most of his physical silver after hitting target prices. Purchased at $20 per ounce when silver was deeply undervalued and hated, his silver investments surpassed expectations, reaching $75, far above the $50 he initially predicted. Rule emphasizes that gold remains underowned and serves as a critical long-term store of value, protecting against the U.S. dollar's projected 75% decline in purchasing power over 10 years. By de-risking his portfolio with senior gold stocks and holding physical gold, Rule balances potential upside while safeguarding wealth in uncertain monetary conditions. Let's get back to the interview.
People who have been listening to our interviews over time, going back 5 years, I think will understand that a lot of the move that we've seen in gold and silver was merely pent-up price action. The circumstances that are in place today that are propelling gold and silver were in place in 2021 and 2022. But people's expectation of the future is set by their experience in the immediate past. So although the facts were laid out in front of them, they didn't have the courage to act. Gold and silver were coiled springs, and some of the tension has been taken out. It's as simple as that. Now, I need to say to people that most people require, even if they understand a narrative, price action to justify the narrative. And it's wild to see a circumstance where more people want to buy silver at 80 than did at 20. When the price moves from 20 to 80, understand that it is precisely 80% less attractive. That's just the way it works. The easy money is made when you buy based on hate. If there's a popularly held public pretense that's wrong and you bet against it, that's the easiest money financially you can make and the toughest money psychologically that you can make. I believe, Dunnigan, as you and I have discussed many times, that gold and silver continue higher, but probably at a less voracious pace. I believe it not because the price has gone up. That makes it less attractive. I believe it because I believe over 10 years the purchasing power of the U.S. dollar declines by 75%, which is, sadly, very good for the nominal price of gold and silver. So I suspect we'll continue to have good years. If you try to measure the years that we have in the future, by 2025, you will almost by definition be disappointed. With regards to silver, as I said, I bought it because at $20, I believed it could go to 50. I believe it would do so in 2 years, which meant that I would enjoy a 2-year double. I was wrong. I enjoyed a 2-year triple or better. But the point is that the position that silver inhabited in my portfolio meant that the reason that I bought silver had occurred and its utility had occurred. And then I had to think, is that portion of my portfolio, that speculative portion of my portfolio, best reflected in physical silver or best reflected in a different asset class? So teaching people the discipline of putting their buy decision down in writing and establishing a template and a discipline around selling is an important part of keeping the money that you make in a bull market. Most people, Dunnigan, in this bull market, sadly, will miss it. They'll come on late, they'll ride it up through the blow-off phase, and they'll hold it on the way down. And that's a tragedy. I did that my first bull market. I went from being an extremely wealthy young guy in the middle of that bull market to having a net worth below zero after the end of it. And that's not going to happen to me again.
Rule explains that much of the recent surge in gold and silver reflects pent-up price action from 2021-2022. Many investors lacked the courage to act when metals were undervalued, buying silver at $20 rather than $80. Rule emphasizes that the easiest gains come from buying when assets are hated, not popular. While future gains may be slower, he believes gold and silver will continue rising as the U.S. dollar loses purchasing power. Over the next decade, Rule stresses disciplined buy and sell strategies to protect profits and avoid the pitfalls that plague most late-coming investors in a bull market. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.